Now, to incorporate into this the idea of the money supply, now we're back to the Federal Reserve. Okay, the Federal Reserve can affect aggregate demand by influencing, by controlling the supply of money. What we have to kind of just get back to the basics of what money does. Money facilitates transactions. Okay, when wages go up, the demand for money goes up. When people are buying more, the demand for money goes up. Okay, and so when aggregate demand goes up, the demand for money increases. If you do not increase at the same time the supply of money, the price of money, and we will call the price of money interest rate. Okay, interest rate is the fee, the cost, the price that a bank charges or that anyone charges for a loan. Okay, so just like with anything else, if demand goes up and supply stays the same, the price is going to increase. Well, the price of money is the interest rate. And so if you have this increase in aggregate demand with a commensurate increase in the demand for money and no increase in the supply of money, interest rates will rise. Okay? And that's we'll mention that hereafter, but you hear all the time about the Federal Reserve controlling interest rates. The only interest rate the Federal Reserve actually has direct control over is what's called the discount rate, which we'll get to in a minute here when we discuss the tools available to the Federal Reserve. What most people are talking about is the federal funds rate, which is the interest rate charged by one bank to another bank for an overnight loan. Okay, the Federal Reserve doesn't actually directly control that. They can't set that, but what they can do is target an interest rate. And they do this by controlling the supply of money. If they increase the supply of money, that slides the supply of money curve outward to the right and drops interest rates. Okay? So they control interest rates by controlling the supply of money. All right? Now, this is how kind of the invisible hand works with this. Okay? If we hold the supply of money constant, if we don't change it at all, and aggregate demand increases, that's going to push the demand for money outwards to the right, which is going to increase interest rates, which means the price of money is going up. And as the price of money goes up, the demand for money will drop. And so this is an invisible hand, okay? This is an automatic correcting mechanism, therefore, because aggregate demand goes up, and so the demand for money increases. But because of that increase, interest rates go up. Because interest rates go up, the demand for money will decrease. So an increase in the demand for money now, okay, creates the conditions for a decrease in the demand for money in the future, unless you adjust the supply of money. Now, we'll take a look at what's called loose monetary policy. It's often referred to also as accommodating monetary policy, though that's not exactly the same thing. We're going to integrate this with federal policy at the end of this, or with fiscal policy, rather, at the end of this. If monetary policy and fiscal policy go hand in hand, if they work towards the same end, then it's referred to as accommodating. So if fiscal policy is moving in the direction of an expansion, of economic expansion, such as they're dropping tax rates or increasing aggregate or increasing government spending, and the Fed at the same time is increasing the supply of money, that's referred to as an accommodating policy. They're moving in the same direction. Okay. Now, loose monetary policy, to negate the effect of the increased price of money resulting from the increased demand caused by aggregate demand, the Fed can increase the supply of money. Now, let's take a look at this over here and see how this works. This comes from what we previously said. During growth, okay, let's start right here at this point, okay? During growth, wages are going up and aggregate demand is going up. That means the demand for money is going up, okay? Because the demand for money is going up, you see that interest rates are going up. This then will become a terminal condition, because the increase in the interest rates, okay, in the future will slide demand back downwards, okay? To prevent that from happening, the Federal Reserve can increase the supply of money, okay? If they increase the supply of money, that slides interest rates back to their original level, which means aggregate demand will not be reduced. And you'll note that the original increase in aggregate demand and the increase in the demand for money created an increase in output, okay? Okay, and that's generally output in the system and the quantity of money in the system. You increase the supply of money, thusly, and it increases output still more, okay? And it keeps interest rates the same. Right now, interest rates have been nominally going up. The interest rates rose 4 times, the federal funds rate rose 4 times in 2018. This year it has yet to rise. The reason it's rising is because you have an increased demand for money, okay, that would ordinarily push interest rates higher from IR1 to IR2. The increase in interest rates is somewhat below that because the Federal Reserve has actually increased the money supply, but they have not increased the money supply enough to keep interest rates where they originally were. Hence, there's been an increase from roughly 1.25% to 2.25% to 2.5%. Right now, the federal funds rate is between 2.25%. The target is between 2.25 and 2.5. That rises up from 1. The lowest they were was 0.25. Okay, that's because the Fed has increased the supply of money, but they haven't increased it enough to bring the interest rates down to their original level. And the reason for this has to do with the overheating of the economy. Okay, they don't want to allow, they want to rein in aggregate demand a little bit, which is why Jerome Powell, the head of the Fed, has been criticized by the Trump administration, because Trump is trying to create continual economic growth, at least until he goes to be reelected. And so if the Federal Reserve doesn't commensurately, okay, increase the supply of money enough, interest rates will go up, and that will have the effect of pulling back on aggregate demand. Okay, there's a reason for doing this. Okay, the reason is that you do not want aggregate demand to push to the point where the increase in prices that results from the increase in aggregate demand, where that increase in prices outstrips the increase in wages. Okay, that's kind of what we're getting at here, is the idea that, you know, it may seem desirable, okay, and new students to macroeconomics and how this system works normally think, well, given that, you can just increase aggregate demand indefinitely and prevent a recession from ever happening. All you've got to do is, as wages are going up and income levels are going up, okay, people are buying more, the demand for money is going up. All you've got to do is release more money in the system. It keeps interest rates the same and prevents aggregate demand from ever being pulled back in the other direction. Hold on here a minute. Remember that there is a natural process in the business cycle. As aggregate demand goes up, and as the demand for money goes up, okay, as everything is growing, wages are rising, okay, eventually you reach the point where you're what's called the full employment level, okay, where the demand for labor begins to flatten out. And as it flattens out, okay, as the demand for labor begins to flatten out, wages stop increasing as much. At the same time, because of that aggregate demand push, prices are continuing to rise. They eventually reach the point where prices outstrip wages, people have less real income, and it triggers a recession. You're not going to prevent a recession from happening. It is a natural byproduct of the business cycle. It is an inevitability. It is like the rising of the sun. Okay? It will happen. The question is, when will it happen and how severe will it be? All right? And so what we want to try to do is bring in for a soft landing. Okay? As we see the economy beginning to get to this point where the increase in wages is not keeping pace with the increase in prices, that means recession's on its way. And so we want to ease into that recession. Okay? The best way to describe it that I've ever heard, it was from one of the Fed guys. I want to say it was from the guy that's in charge of the Dallas Fed. Think about it as an automobile, okay, moving towards a traffic signal. Okay, you begin to move towards that traffic signal. Okay, the light is green, but it's been green for a while. Inevitably, that light is going to turn yellow and then red. And so what you do as it turns yellow, you don't know how long that yellow light's going to last. As it begins to turn yellow, you have a number of choices to make. You need to decelerate so that you don't run through the red light and crash into other vehicles. So what do? You begin to ease up. Now, there's two ways of doing this. One, you give up on the accelerator and begin to press on the brake. That's what the Federal Reserve did last year. They eased up on the accelerator and they very gently pumped the brake 4 times, okay, to slow the car down a little bit as it's moving towards this, okay? The decision that the Federal Reserve made in January not to adjust interest rates, not to try to adjust interest rates, but to wait and see, okay, is the equivalent of you begin to slow the vehicle as it goes towards the traffic signal, but you've now slowed it to the point where you don't know whether or not the vehicle actually is going to go into the traffic signal, okay, when it's going to get there. All right, you don't know kind of how far away the traffic signal is. If you keep decelerating this way, you could stop short of the traffic signal. You could end up being completely stopped while the light is still yellow, and you don't want to do that, okay? And so it's really a question of how you want to ease into this recession, not preventing it. They tried that. Greenspan believed that you could prevent a recession from happening just by continually keeping the supply of money flowing, keeping interest rates very low. Whenever aggregate demand goes up, you just put more money into the system and you can prevent it indefinitely. The result of that is here you are driving along, there's the traffic signal, you see it green, you see it now turn to yellow, okay? When it turns to red, rather than when it turns to yellow, okay, beginning to ease off, or if you sense it's about to go yellow and then red, easing off the accelerator and gently slowing towards the light, okay? The other option is you keep going barrel ass as fast as you possibly can. The light turns red. All of a sudden, you have to slam on the brakes as hard as you can. You're probably not going to be able to stop in time, and you're going to crash into the semi, okay, that's coming the other way. This is what happened in 2008. Greenspan refused to ease the car into it. He believed, think about it this way, okay? Here you are coming up to a train crossing, okay? There's a train off in the distance coming towards. You're moving towards the train crossing, okay? You're moving towards the intersection. Here comes the train coming from the other direction. You got to make a choice. Choice number 1, do you think you can beat the train? Okay, well, yeah, you can try that. Gun it. This is what Greenspan did. Gun it as fast as you can. Okay, try to beat the train. Problem is, if you don't beat the train, it slams into you and everybody dies. That would seem a bit risky. Not Dow, it didn't. And as a result, the economy lost during that period in the neighborhood of 7.5%. Okay, in the neighborhood. Not a good thing. The other way to do it is to say, okay, we want to get as much distance as we possibly can. So we leave off the accelerator. Okay, if we're getting too close as the train approaches, we begin gently to press on the brakes. All right. The fact of the matter is, the train is going to cross. The train is coming. Okay, the recession is an inevitability. Okay, the question is, how do you want to slow as you go towards it? That's the idea of the economy overheating. All right, and that's all what we've talked about before. The Federal Reserve has been given by the government essentially two mandates: to attempt to maintain stable price levels. How do you maintain stable price levels? By not letting aggregate demand get out of control. If aggregate demand increases too much, okay, then prices are going to rise beyond a stable level. The adjusted price levels, okay, based on January figures, the adjusted price levels from a year ago are between 2 and 2.2%. Okay, that's what inflation was over the last year from January 2019 to January 2019. Their estimate is it's between 2 and 2.2%. Okay, the Federal Reserve deems that as a stable price level. That's their target figure. Their target is between 2 and 2.5%. Okay, is increase in prices. The increase in prices is inevitable. It has to happen. There's no way it can't. Given aggregate demand, there's no way it can't happen. Okay. At the same time, their other mandate is stable employment levels. Okay? You want employment to continually rise, but to do so slowly. All right? Now, eventually, we all know that this is going to stop. The question is, how do you want this to fluctuate? Okay? And I'll just show you with the laser pointer here. Okay? You can have the economy fluctuate like this. Okay? Dramatic aggregate demand increases with dramatic price increases, and dramatic aggregate demand decreases with dramatic price decreases. Or you can have it move like this. This is more stable. Okay? That's what we're going for. That's the idea of a neutral rate that the Federal Reserve is going for right now. Okay? And so to accomplish this, the Federal Reserve has to maintain continual monitoring of aggregate demand, of employment levels, of price levels, and how all of this is fluctuating. Okay? And that's why what Jerome Powell said in January of 19 at the Federal Reserve meeting was that, look, the decision was made not to target a rise in interest rates as they had 4 times last year. And he said, instead, we're going to have a wait and see policy. We're going to wait till data rolls in. We're going to keep watching all this. And as data rolls in, we're going to reserve the flexibility of either keeping interest rates the same or increasing interest rates or decreasing them based on where we think we are in terms of the traffic light, in terms of, the oncoming train, okay, that's going to the intersection. Okay, we need to take a look at the data and see what we need to do. We're not going to be tied to any particular policy. All right, we need to pursue so as to maintain these stable price levels, which at this point we're doing, and to maintain stable employment levels. If any of that changes, then we reserve the right to do what is necessary. Okay, which is why what he talked about doing was maintaining an ample portfolio of bonds at the Federal Reserve that they can at any point in time either sell or buy or do what they need to do. They need to maintain that latitude based on what data comes in. On to the mechanics of the Federal Reserve and how it technically works. As I've said, They have three basic tools at their disposal, of which I've mentioned two. These are the least two that are used. Okay, you have the reserve ratio. The reason we don't use this one as much is because it has the most dramatic effect on the system. This is because it adjusts the money multiplier. If we increase the reserve ratio, then that's going to really squash the multiplier. So that increases in excess reserves are not going to have as much of an effect. So too, if we decrease the reserve ratio, that's going to increase the money multiplier, which is going to have a more dramatic effect. So we don't want to do this, okay? This is the equivalent of slamming on the gas or slamming on the brake. We don't want to do that, okay? So we do that very infrequently. The second mechanism is the discount rate, as I said. When we talk about interest rates, when you hear in the news about interest rates, the general interest rate you hear about is what's referred to as the federal funds rate. Okay, that's very different than this one. This is the discount rate. The discount rate is the interest rate that is charged by the Federal Reserve to its member banks for an overnight loan. That is different than the federal funds rate. The federal funds rate is the interest rate that one member bank charges another member bank for an overnight loan. Now, of course, what you're wondering is, why do you need this overnight loan? Let's go back and look once again at the idea of how banks make money. Banks make money by lending it out. Therefore, a bank has an incentive to lend out every penny that it can. Okay, that's how they make money. Well, every 14 days, every fortnight, I always like to use the word fortnight because it's a cool word. Every 14 days, the Federal Reserve audits the accounts of its member banks to make sure that they have their reserve requirement. Well, what do we do if the day before the Fed audits our account, we don't have our reserve requirement? The answer is we borrow money to put into our account so that we do have the reserve requirement. All right, you have two sources of lendable funds. The Federal Reserve, you can borrow it from them at the discount rate, or you can borrow it from another member bank for an overnight loan. You literally will on day 13 borrow it, put it into your account, and on day 14 pay it back. Okay, that's the federal funds rate. The discount rate is always slightly higher than the federal funds rate, okay, to act as a disincentive. Okay, the Federal Reserve doesn't really want to have to lend its member banks money. They would rather the member banks borrow from one another. Okay, this too is not a frequently changed thing. This thing changes every time the federal funds rate changes. Last year, the federal funds rate changed 4 times. And so as a result, the discount rate changed 4 times. By far the most frequently used, it's used on an almost daily basis, at least a monthly basis, is what's called open market operations. Okay, and there is a FOMC, the Federal Open Market Operations Committee. Okay, what they do is they buy and sell bonds. And we'll see in just a minute how that adjusts the supply of money, which in turn adjusts interest rates. Okay, and this is what I was saying about the difference between the discount rate and the federal funds rate. The discount rate is the interest rate charged by the Fed to member banks for an overnight loan. Interest rate charged by other member banks for an overnight loan is the federal funds rate. Okay, the Fed has direct control over the discount rate, but only indirect control over the federal funds rate. And you see how they control it. If the supply of money goes up relative to aggregate demand, then the federal funds rate drops. All right, and vice versa. Here we see the supply of money, interest rates, and the demand for money. Okay, again, here's the demand for money, given a particular level of prices and income. All right, if the Federal Reserve increases the supply of money, interest rates drop from IR1 to IR2, okay? And because of that, the demand for money goes up, all right? Just like any supply shift. If they reduce the supply of money, interest rates go from IR1 to IR3. Now, we look at open market operations. And I have a little diagram of this as well to help explain this. This is the buying and selling of bonds. Bonds are, as you know, as we've talked about before, a bond is an IOU. Okay, the Federal Reserve maintains a portfolio of bonds, okay, of IOUs that it holds. If it buys bonds, it does so with money. This is the principal means by which it's going to adjust the supply of money. When it buys bonds, it sends money into the system, and the bonds come out of the system and get held at the Federal Reserve. When it sells bonds, okay, it does so for money. That draws money out of the system, okay, and puts the bonds back out. When the Fed buys bonds, this releases money in the system, which ultimately gets deposited in banks, increasing their available reserves. When the Fed sells bonds, this pulls money out of the system, reducing banks' available reserves. And here is the diagram of this. And so let's go through this with what we've just said on the previous slide. Okay, let's look first at the Fed buying bonds. Money comes out of the Fed. Okay, it goes into the system. These bonds get bought by banks, individuals, corporations, whatever. Okay, the Fed buys these bonds. Okay, now I should reverse that. It buys bonds, okay, from banks, individuals, corporations, from the system, okay? It can also buy it from the government, all right? It can buy it from anyone. They buy these IOUs. Anything they do, that releases money into the system. In exchange, the bonds come out of the system. This increases the supply of money in the system when they buy the bonds, okay? Because all this money with which they buy the bonds ultimately gets deposited in banks, and because of the dual use of money, that's going to affect both the amount of consumption and the amount of lending. Okay, it's going to affect banks' excess reserves. This is going to increase the excess reserves of banks, because even individuals and corporations are eventually going to deposit that money in a bank. Nobody keeps their money under a mattress anymore. Okay, they deposit it in a bank. Okay, the opposite of this is when the Fed sells bonds. When the Fed sells bonds, they can sell them to banks, individuals, corporations, anybody. Anybody can buy the bond. Okay, the bond comes out of the Fed, and in exchange, money is drawn out of the system. Okay, these people over here, the system, okay, the banks, the individuals, corporations, this time they're the ones buying the bonds. And so money goes into the Fed, it comes out of the system, that reduces excess reserves, reduces the amount that can be consumed, reduces the amount that can be lent out. We do this if we're worried that the economy is overheating, that we're moving too quickly to the red light, that we're moving too quickly towards the train. Okay? We don't want to do that. We want to ease into it. All right? And that's why interest rates, what in point of fact has been happening for the last 2 years or so is what they've referred to as quantitative easing. Okay, and that's not the first 2 years. That's really 5 years ago. Okay, what they've been trying to do is gradually bring the interest rates up a little bit. Okay, to slow things down a little bit. Okay, so that when the recession hits, which is an inevitability, it won't hit severely. It won't be a dramatic collision. Instead, it will simply be drifting into it in the hopes that by only drifting into it, it will not be a severe recession. Okay? See if that works. And we've talked about this before. I'm just kind of recapping it. An increase in the supply of money puts more money in the banks, which makes more money available for spending and investment, which shifts the AD curve outward. Decrease in the supply of money takes money out of banks, which makes money less available for spending and investment, which shifts AD curve inward. The increase in the supply of money, interest rates drop. Decrease in supply of money, interest rates go up. And what I've said is what's been happening the last year or so is that interest rates have been rising, even though the supply of money has been going up gradually. And that's because what they've been doing is they've been monitoring, they've been incrementally tweaking the supply of money, okay? So that the supply of money is going up a little bit, but it's not going up as much as aggregate demand is going up. This is having a slowing system on the economy, so that instead of getting 3% or 3.2% economic growth, okay, with the commensurate price increases, you're going to have 2.3 or 2.4% growth with less of a price increase, greater stability. That's the basic idea with what they're going for. That's the idea of maintaining a neutral rate. Expanding the money supply will hence have the same effect on aggregate demand as expansionary fiscal policy, whereas contracting the money supply will neutralize expansionary fiscal policy. And as I mentioned before, this is why the Trump administration has been critical of Jerome Powell for the last 6 months or so, because the Trump administration is pursuing an expansionary fiscal policy. Okay, increased government spending, reduced taxes, that's expansionary fiscal policy designed to drive up aggregate demand, to drive up aggregate supply, and to extend economic growth. And what the Fed's been doing is not really either accommodating or restricting this. Okay, what they've been doing is they've been more modestly, more moderately increasing the supply of money, but not enough to keep pace with the expansionary fiscal policy. What the Trump administration would like to see them do is massively increase the supply of money, okay, to accommodate this massively expansionary fiscal policy. The Fed doesn't want to do that, but neither are they dramatically decreasing the supply of money as would happen in a restrictive policy, okay? And a couple of weeks back, after Jerome Powell made the announcement that the Fed was going to be leaving interest rates alone, that was on a Wednesday, that Friday, he had his annual dinner with Trump, and he reiterated to the Trump administration that the Federal Reserve is not a political agency. Okay, they have no concern whatsoever with the political cyclical movements of the political cycles in the United States. They couldn't care less about midterm elections or presidential elections. Their concern is their mandate. They need to maintain stable prices and stable employment levels. Okay? And he said they will do whatever they deem necessary to accomplish that. And so if the Trump administration is pursuing a dramatically expansionary fiscal policy with tax cuts and increased spending, okay, that threatens to push prices too high. Okay? And if prices are pushed too high, they are going to expand beyond wages as the demand for labor begins to flatten out. If you push prices too high, too quickly, with too much of an expansion, you're going to reach the point where the increase in wages is less than the increase in prices. That's going to trigger a recession. And the more you do that, the more dramatically you do that, the more dramatic the recession is going to be. So to prevent that from happening, what the Fed has been doing is easing off the accelerator a little bit. Okay? So the Trump administration is kind of the passenger, that keeps telling the driver to go faster and faster and faster. You can beat that train. Come on, we can beat that train. You got to keep going. You got to keep going. And the driver's saying, you know what? I'm not entirely sure we're going to beat that train. How about we slow up a little bit, okay, and try to just gradually ease into stopping. then the train can pass by and we can continue on our course. And that's where they get into the debate. Okay. And so this deals with monetary policy. We've talked about all this before. This is just kind of recapping. There is inflationary pressure that is inherent in the system when there is growth. Okay, you have an expansion of aggregate demand. That creates inflationary pressure. The Fed can neutralize this pressure with a tighter policy, a more restrictive policy, or, if you prefer, with just a less accommodating policy. As I mentioned, the metaphor I keep pressing over and over and over is there's two ways that you can slow up as you move towards a light. You can either ease off the accelerator and kind of drift into it, or you can drive as fast as you can up to the light and then slam on the brakes and hope to be able to stop. All right. Now, during a recession, the Fed can change this altogether. Okay. To trigger growth, the Fed can launch an expansionary policy. Okay. So once the recession does come, all the Fed needs to do is drop interest rates a little bit. And one of the problems they got into last time, and Greenspan was still really kind of in charge at this point, but it was in that transitionary period where Bernanke was about to take over, is, you know, there's such a thing as a liquidity trap. Okay, you reach the point in terms of the sensitivity. What we deal with here, and I don't really get into it at any great length here. Okay, the basic idea is that if you lower interest rates, that's going to increase the demand for money. Okay, the question is the sensitivity. Given an interest rate change, how sensitive is the demand for money? Well, you reach a point with interest rates where you reach what's called a liquidity trap. Okay, if interest rates are low, are really 0.25%, then tiny perturbations of that is not really going to affect the demand for money at all. Okay, you have to have some sort of cushion in interest rates in order for you to be able to drop them. I mean, if your interest rate's 0.25 and there's a recession, how the hell are you going to drop rates to help trigger growth? You got no rates there. So you need rates to be up at a level. What Powell's thinking, what the Fed's thinking, they thought at first 3% was maybe the neutral rate, was the rate that you want to have to maintain stable prices, maintain stable employment levels. Now they're thinking, well, you know what? Those price levels are pretty stable. Employment levels are pretty stable. Maybe we're really more about 2.5% for interest rates. Okay? We want to keep that there because when the recession hits, if we ease into it, when the recession hits, it's going to be a fairly gradual, a fairly modest recession. We can tweak it and create aggregate demand again by dropping interest rates a little bit. 25 base points, a quarter percentage point, half a percentage point. Okay? Well, to be able to do that, you have to have some sort of an interest rate. They discovered this when they dropped rates to the lowest level, is that any further drop is having very little effect on the demand for money. Now, as a conclusion of this, and hopefully what you gather from this, is that the Federal Reserve's monitoring of the system and adjustment of the prices and the way the monetary system in general works is not a precise science. Okay? It's really more of an art form. Okay? And we go through the last few chairs. Okay? Alan Greenspan was chair of the Fed from 87 to 2006. During his entire tenure, now he comes in 87 during a very bad economic time. This was the Reagan administration. The economy was still sluggishly recovering from the stagflation of the late 70s. So Greenspan came in and immediately began an expansionary monetary policy. Okay? That pushed things very quickly. That led to, in his defense, that led to the longest period of continual economic growth in U.S. history. Okay? Which generally lasted from 91 until 2001, when a very modest recession hit. Okay? At which point interest rates were still 1.25%, 1%. He could drop those down, creating more economic growth. The problem is he dropped them to the level that the demand for money increased too much, okay? And as a result, you had too much economic growth, and that led to the catastrophe in 2008, okay? And so the Fed pursued expansionary policy for too long, resulting in overlending, overborrowing, amassing massive private debt, topping out at better than $3 trillion. And I just saw this, that last week, private debt in the United States now exceeds private sector debt in the United States, household debt actually in the United States, exceeds $4 trillion, which is the highest it's ever been in history. Okay, that's a danger signal. That's a danger signal. Okay, because the financing on that debt at say 2% or 3%, if we figured at 3%, that would be 3% of $4 trillion is what, about $12 billion? That's the financing of that debt. That's an enormous amount of money that households have to use just to simply pay back the debt they've accumulated that they can't use for continual consumption. Okay, is a simple way of explaining that. And so all of this lending and all that led to the banking crisis, led to the Great Recession of 2008. Okay, Greenspan admitted that he screwed up, that he underestimated kind of the way he phrased it was that he underestimated the greed of the banking sector. He didn't expect that when the interest rates were that low, that the banking sector would give out as much loans as they could. Okay, and I don't understand that. Greenspan's brilliant. I don't understand how he did not see that coming. But I guess hindsight's 2020. It's easy for me to sit there and say, "Al, buddy, you know, come on, you should have seen this coming." How do banks make money? They make money by lending it out. Okay, so when you give them cheap money at very low interest rates, of course they're going to lend it all out. But that's hindsight is 2020. Okay, well, Ben Bernanke takes over. Now, Ben Bernanke is a little bit different. You know, it's very similar to the difference in how you play chess. Okay, my father and I pursued the game of chess very differently. To my father, chess was mathematics and science and precision. Okay, and that's more like Garry Kasparov. Okay, if you follow chess at all, it's more like Garry Kasparov. Whereas the way I played chess, it was more of an art form. You feel it. Okay, you move, you be creative. Okay, that was the way Bobby Fischer played chess. Now, Bobby Fischer was, of course, a very crazy person, so they go hand in hand. All right. Well, Bernanke was more the mathematician. He saw a specific formula for interest rates, growth, aggregate demand, all of that. And he ran the Fed from 2006 to 2014. He was succeeded by Janet Yellen, who was very similar to Bernanke, but not quite as extreme in his scientific approach to it. It was a little bit more mixed with a little bit of the artistic side of Greenspan. Okay, and they pursued quantitative easing. The basic idea was to gradually rein in the supply of money. Okay, allowing for economic growth to keep going. But the fact is that under Greenspan, the supply of money just simply got out of control. That's what led to all that private sector debt and ultimately the Great Recession of 2008, 2009. So we need to rein that in a little bit. Okay? Well, that's quantitative easing. They gradually reined it in and indexed it more to GDP. For Bernanke, it was a specific function. Yellen played a little bit looser with it. Okay? Well, Yellen was succeeded last year in 2018 by Jerome Powell. And what Jerome Powell has instituted and the Fed has instituted is what they're calling the neutral rate. What they're pursuing is something that's never been pursued before. This has never been attempted before. And Powell's discussion in January, his press conference in January, is really an admission on his part that he does not see this as quite as scientific a study as Ben Bernanke. Neither does he see it as artistic a venture as Alan Greenspan. It's somewhere in the middle. Okay? It really is based on the interpretation of the data and how manipulations in the supply of money are going to affect the demand for money and therefore aggregate demand. And what we want to pursue is a neutral interest rate, such that it neither squashes growth nor leads to economic overheating. What we want to do, and this is the metaphor I've been pressing home, is what we want to do is the idea of, as we move towards the end of the growth cycle, rather than stepping on the brakes, we just want to ease off the accelerator a little bit. We want to gradually drift into that light, okay, so that we don't crash. That's the basic idea. Will it work? We don't know. So far, it seems to be going well. It's funny, too, because about a month ago, a little better than a month ago, I saw an interview with Alan Greenspan, because it's really quite unusual what's going on in the economy. And that's one of the things I want you to get to the point, is that you can understand why it's unusual, what's going on. You have unemployment levels at about 3.9 or 4%. Okay? That's below the full rate of employment. At the same time, you have a stable inflation rate of 2 to 2.2%. You have increases in the nominal money supply. It doesn't make any sense. It doesn't make sense that the economy can continue to move in this growth direction the way it is. Something is amiss. That's what Greenspan was talking about. He said, this is about a month and a half ago, he was talking about how something in the economy isn't quite right. There's something not making sense here. Everything seems to be going smoothly towards continued growth, towards an extension of this growth cycle, which has outstripped the previous one. It's now the longest growth cycle in U.S. history. But something underneath isn't quite right. And he couldn't put his finger on it. It was like, I don't know exactly what it is, because private sector debt, before in 2007, okay, private sector debt was astronomical. So if you were looking closely enough, you could see there's something wrong there, okay? Well, private sector debt is not astronomical as a percentage of GDP. And so it's kind of like, something's not right here, okay? But we don't know what. That's why what Powell's doing now is saying, you know what? We're going to ease up on interest rates. We're going to take a look here and see what's going on. At what point are we going to hit this red light? When is this recession coming? Nobody knows. We know that it is. We don't know when. And so that's kind of why it's a very interesting game to watch being played. And personally, I have actually great faith in Jerome Powell. If you haven't heard him speak, you really should. You should just Google one of the press conferences. Google the press conference in January, for example. One of the things that's happened under Powell is they've decided upon greater transparency. So now every time the Federal Reserve Board meets, they're going to have a press conference. That was not always the case. They used to do it just when they would change rates. Now they're going to have it every time, even when they don't change rates, just to try to become more transparent about the process. Okay? And he's really he literally, his press conference lasted, what he had to say took about 10 minutes. Okay? And then there was questions and answers. And so I happen to have faith in the guy. Okay? But don't take my word for it, because I also had faith in Alan Greenspan and was shocked. He actually came off my wall as one of my superheroes when that happened. It was really quite humbling for all of us. But I kind of have faith in Powell. I like the way he's moving. I like the way he's directing things. We'll see whether or not it works, because it hasn't been attempted before. And with that, we'll just conclude this. And as you see, it's a little bit still up in the air. But that gives you the basics of the Federal Reserve System, how it works, even a little bit beyond the basics. And that concludes 2.4.